I've grown my investment portfolio to almost £500,000 in 15 years with just an ordinary job in the education sector. And in this video, I want to share with you 10 important things I've learned throughout my financial journey to build wealth and become financially free in a relatively short space of time. None of this is financial advice, I'm simply showing you my own journey. Right, let's get straight into it. Number 1 is emergency fund. Before investing, you should have some sort of easily accessible fund so that if you need a large sum of money for an unexpected reason, you don't have to hit the sell button on your investments and can allow them to compound over time. But what size this fund should be depends on your own particular circumstance. A rough guideline is to have enough to cover 3 to 6 months of living expenses. This includes costs like rent or mortgage, bills, food and other necessities. It should be kept out of the stock market. Personally, I like to use premium bonds. Instead of receiving interest, there are random cash prizes each month, the largest one being £1 million. Your capital is safe and any prizes are completely tax-free. I haven't won £1 million yet, but for the whole of 2023, my cash prizes total £3,075. I won't expect this every year, however, and sometimes I go several months in a row without winning a thing. Number 2 is habits. Regularly investing into the market no matter what it's doing. Having a pension helps with this process, and if your employer and also the government are contributing too, then having a pension seems like a no-brainer. Investing into your portfolio doesn't mean you have to invest the same amount each month, just that you are doing it regularly. I always reinvest my dividends, but the amount of new money going in varies. If the market is soaring and breaking new records, I'll actually hold some back and save it. And when the market crashes, I'll use some of that saved money to snap up some bargains. Some might say this is market timing here, but I'm only making slight adjustments and I'm happy with that. Everyone loves a bargain and psychology is so important if you are to stick at this for decades. And that leads me to my next key point, motivation. Investing is a long-term process and unless you enjoy it, you might find it hard to stick at for the long term. I personally find dividend investing very motivating indeed, and yes, it might be suboptimal in a financial sense, but if it motivates and interests me and provides joy, then I'm likely to stick at it for decades. Often a good path which you can stick to is better than the optimum path which you lose interest in and give up when the going gets tough. Many years ago, when I was making mortgage overpayments, my bank gave me 2 options. 1, to reduce the term of the loan, or 2, to reduce the amount I would have to pay each month. I knew that option 2 would be more expensive, however it was also more motivating to me seeing those payments reduce each month. It seemed more tangible than seeing the time remaining going down. So that's the one I chose, and in 10 years the mortgage was gone and I was totally debt free. I'll leave a link above to show how I achieved this if you want to find out more. I also set myself small targets along the way which I find motivating. My very first target was to achieve enough passive income to afford just 1 cup of tea a day, and I just went on from there, from a cup of tea a day to affording a Big Mac meal a day. Today my passive income can pay all my essential bills, and I'll explain everything in the video above if you want to know how this is done. Number 4 is investing platform. When I first started my current portfolio in 2009, there was not a lot of platform choice and it cost me an incredible £12.50 per trade, not including stamp duty. There was also an inactivity fee if I didn't trade often enough, and I was restricted to buying individual UK stocks. I chose what I believed to be the best option at the time. Now, however, there is so much choice available and the costs have dropped dramatically. There are even platforms which are not only commission free but pay you interest on the cash in your portfolio, as well as giving you a free share worth up to £100. If you like the sound of that, then you can sign up to Trading 212 by clicking on the link in the video description. You can now start putting your money to work. Number 5 is reduced tax. Yes, when you make some tasty profits from your investments, the taxman will want his share of it. If you sell your investments for anything more than a £3,000 profit in any tax year, you could be liable for capital gains tax charged at 10% for basic rate taxpayers and 20% for higher rate taxpayers. These are the current rates, but there are rumours that the government may increase capital gains tax in the near future. For dividends, there is currently a £500 yearly allowance, and anything above this will be liable for dividend tax at 8.75% for basic rate taxpayers and 33.75% for higher rate taxpayers. Please note that these rates are accurate at the time of this video, so do please check what the current rates are. Considering all this, it may well be worth choosing not to open an ordinary account on your chosen investing platform, but making sure if you are a UK resident to open a stocks and shares ISA account, which you can put £20,000 of new money a year into, and all dividends and capital gains will be completely tax-free. Number 6 is diversification. When it comes to investing, you don't want to have all your eggs in one basket. You want to have a range of assets covering different sectors of the economy and different geographical locations. Investing in global index funds is becoming incredibly popular, and an exchange-traded fund such as VWRL gives you exposure to around 3,500 companies from around the world, all in one share. When I started investing, ETFs were not mainstream, and I became accustomed to buying shares in individual UK companies like the ones shown here. These days, however, I'm more diversified, as now I have a range of exchange-traded funds, giving me exposure to thousands of companies worldwide. Number 7. Go passive instead of active. Passive investments simply track an index for a very low fee. You won't outperform the market because you are basically buying the whole market with a global index tracker, for example. Active funds essentially mean paying a professional to select investments for you, but for this they will charge fees, and sometimes these fees can be quite large. In 2008, the legendary investor Warren Buffett bet $1 million that no fund manager could outperform a simple passive S&P 500 index fund over 10 years when all their exorbitant fees were taken into account. Only one hedge fund took up the challenge, Protege Partners. After 10 years, the hedge fund made a profit of 2.2%, but the S&P 500 passive income tracker rose 7.1%. Buffett won the bet and donated his winnings to charity. Today, there is overwhelming evidence that in the long term, most people would do far better investing in a simple index tracking ETF than picking investments themselves or paying people to pick investments for them. The industry does its best to make investment and wealth creation seem as complex as possible, but sometimes the simplest and cheapest strategies are actually the best. But do they really want you to know this? All you really need to do is spend less than you earn and invest the rest into a passive index tracking ETF. Then plenty of time to let compounding do its magic to beat inflation and secure your financial future. Number 8 is to ignore volatility. Many investors confuse market volatility with risk. Yes, the market moves up and down on a daily basis, and so will the value of your portfolio. Sometimes the swings can be huge. However, over the long term, markets go up. Here is a chart of the S&P 500 over the last 90 years. Sure, there are ups and downs, but there is not a single 15-year period in its entire history when it would have lost you money. Investing for the short term is risky because you can't predict where the price will be when you sell because of all the short-term volatility. But over the long term, it's a bit like bouncing a ping pong ball while climbing a flight of stairs. The longer you are climbing the stairs, the less chance you have of losing money, as even if the ball is at its low point, it's probably going to be higher than when you started, at the bottom of the staircase. The moral of the story is continuous investment over a long period of time is how to build wealth. Number 9 is to track progress. Monitor your expenditure and income. When we measure something, we can start to improve it. I use nothing more than a simple Excel spreadsheet to track my finances. As soon as I started doing this, my mind was suddenly focused on getting rid of debt, spending less and investing more. I also track my investments, but I'm not too worried about the month-to-month fluctuations in the portfolio value, as I know that can be unpredictable. Over the long term, it should go up. Today, my favourite calculation for motivational purposes is adding up all the dividends paid to me over the last year and dividing by 12, which gives me average dividends per month. It's really motivating seeing this figure go up year after year. Taking a look at your portfolio once in a while is not a bad idea, and a bit of rebalancing from time to time or spring cleaning might be needed. but do be careful not to meddle with your portfolio too often. Fidelity, one of the biggest asset managers in the world, performed a study on their best performing client accounts, and the highest returns came from investors who forgot they even had accounts or who had died. Most of the time, the market rewards investors who get into position and then do nothing. While it seems simple, it's a lot harder than it sounds. Successful investing can be extremely boring, and it can be hard to watch the news and resist tinkering with your investments to try and squeeze out every last ounce of performance from your hard-earned capital. But the market rewards patience and punishes those who give in to emotions. Number 10 is to live frugally, and this is perhaps the most important factor of all. My default behaviour, even from an early age, was to save. I've heard many investors talking about paying yourself first on payday, which basically means paying your future self first by investing a set amount of money as soon as you receive it. I feel, however, that my workplace pension already ticks that box, but when it comes to my share portfolio, I actually pay myself last, because my default behaviour is always to pay off debt, save and invest. If I had put a set amount in each month on payday, I might think that's my investing done and then feel justified to spend what's left on unnecessary stuff, and I could therefore be underinvesting, potentially costing me hundreds of thousands over the long term. By paying myself last, I know that my essential expenses have already been paid. Then I can make conscious choices on things I want, and then everything else gets saved or invested. This video has summed up the rules I followed on my own 15-year investing journey. And if you want to know what rules the greatest investor of them all follows, then click this video here.